Hey everyone, welcome back to Corporate Decoder, the place where we decode the often confusing world of corporate filings. Today we're diving into a Form 8K filing from Sono Group. It's like a financial soap opera with amendments, debentures, and potential stock dilution. Buckle up. This Form 8K means that Sono Group NV had something important happen that they need to tell the Securities and Exchange Commission, and therefore us. The date of the event that triggered this report was April 24, 2025. This is basically a corporate breaking news report. The main event here is about selling company stock in a way that doesn't require registering with the SEC first. Think of it as a shortcut to raise money, but it can sometimes have consequences for existing shareholders because it can decrease their ownership percentage. Sono Group has been working with a company called YA2PN Limited, also known as Yorkville, on some financial deals. These deals involve something called a securities purchase agreement, which is essentially an agreement to sell stocks and a separate exchange agreement. It's like a financial handshake. The deal was first made back in December of 2024, but things have changed since then. They've been making updates or amendments to these agreements. There have been several changes already called omnibus amendments. Basically, Sono and Yorkville keep tweaking the deal as they go. The latest change is called the new Omnibus Amendment made on April 24, 2025. It involves more money coming from Yorkville to Sono. This new Omnibus Amendment includes something called a third debenture. A debenture is basically a type of loan. Yorkville is giving Sono another $500,000, but it's not just a gift. It's a loan that Sono has to pay back, and Yorkville gets something in return. This third debenture is on top of two previous loans called the first debenture and second debenture, making a total of 3 advanced debenture, and second debenture making a total of 3 advanced debentures. All these loans, the 3 advanced debentures and another potential one, are now being grouped together as debenture 6. It is important because it affects another agreement called the exchange agreement and the amount of preferred stock Yorkville could receive later. This third debenture has a maturity date, which is when Sono needs to pay it back, which is April 24, 2026, about a year from now. But Yorkville has the option to extend that date if they want. The loan also has an interest rate of 12% per year, which increases to 18% if Sono misses a payment or defaults on the loan. That's a pretty high interest rate, showing this loan might be a bit risky. Here's where it gets interesting. Yorkville has the right to convert this loan into regular shares of Sono's stock. This is called a convertible debenture. The price at which they can convert depends on a few things. One option is a fixed price of 18.75 per share. The other option is based on the average stock price in the days before they convert, but can't go below a certain floor price. This variable conversion price means Yorkville could get a lot of shares if Sono's stock price drops. This could dilute the value of existing shareholders' stock because there would be more shares in total. Sono received $500,000 from this third debenture deal. That's the immediate benefit for them, but they have to pay it back eventually, either in cash or in shares of stock. The actual legal documents for this third debenture and the new Omnibus Amendment are included as exhibits to this report, so anyone can dig into the details if they're interested. This report was signed by George O'Leary, who's a managing director at Sono Group XD. Now, let's step back and look at the big picture. Sono's getting more money, which could help them with their business, but they're doing it by taking on debt that could turn into more shares of stock. One of the biggest risks here is dilution. If Yorkville converts their loans into stock at a low price, it will decrease the value of the shares held by existing investors. It's like cutting a pie into more slices. Each slice becomes smaller. Sono's strategy seems to be to raise money quickly, even if it means taking on potentially expensive debt. This could be a good move if they can use the money to grow their business and become profitable, but if they can't, they could end up in trouble. Sono Group is in a tough spot. They need money, but they're taking on debt that could hurt their existing shareholders. Whether this strategy works out depends on how well they can use this money to improve their business. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.